AT&T has just reported its earnings, and in the pre-market it is up nearly 5% at $15. This is a company that year to date is down 24% and does offer a yield of nearly 8%. After their really strong earnings, we want to understand, is this a cheap price now for AT&T, which we can expect to see double, even triple over the next few years, as well as getting that yield on cost to double digits, 11, 12, even 13% very soon. In today's episode, we will do a deep dive on the earnings. We'll look at the historical performance of AT&T. We'll jump into their income statement, looking at their top line and bottom line growth over the last few years, their revenue and net income, and we're going to do a quick health check on their balance sheet, looking at their total cash versus total debt position. We're also going to see how some of their competitors are doing, Deutsche Telekom, Verizon, just to name a few, in terms of their total return against their competitors over the last year as well as last 5 years. We're also going to see what are institutions doing. Are they buying or selling AT&T stock? And this is all going to tie very nicely into that all-important dividend safety score, and look at that market cap, as well as some very strong financial metrics you need to understand before investing in T. And as always, we will run it through essentially our stock valuation model. Now, jumping straight into their year-to-date performance, we can see down 24%. However, shareholders who have been holding the company over the last 10 years would have seen a decline of 46%, which is a horrific return on any investment over the last 10 years. But the point of today's episode is to understand, can we expect to see this go back up to the prices that was once seen over $30 and beyond, as well as that yield on cost into double digits. As a reminder, it is trading towards the lower end of the 52-week range. And what we're going to look at now is exactly how well those earnings were. Straight away, we can see they beat on the free cash flow while also boosting their earnings outlook and increase their full-year free cash flow target. So in terms of the numbers, well, how has that been? Well, we can see they posted $5.2 billion in free cash flow for the third quarter, which exceeded the consensus or the analyst view of $4.8 billion. So very, very strong performance, especially in the free cash flow, which is very important for AT&T to maintain those dividends. And we can see they also now expect around $16.5 billion in free cash flow for the full year, whilst previously they had set a target of $16 billion. So very positive so far in relation to that. We can also see their revenue registered around $30.4 billion from the latest quarter, which is up from $30 billion a year ago. Very positive, and on top of that, it did beat the consensus $30.2 billion. So very positive in my opinion in relation to that. Now again, we can see adjusted earnings per share as well, a beat at 64 cents versus 62 consensus. But we can see here from a year ago it was 68 cents. So it was lower than 1 year ago today, but it did beat the analyst consensus target at 62. So quite positive to see. And a final thing just to note, they did post around 550,000 postpaid net additions for the quarter and 468,000 postpaid phone net additions. So very positive to see, and their average revenue per user inched up to around 0.6%. Reasons for this very quickly, just price actions, higher international roaming, and a mix shift to higher priced unlimited plans. So in my opinion, very positive overall for AT&T holders, especially those that were worried about the dividend. Now, jumping straight into the performance of the company and the income statement, well, year on year, what we like to see is 3 to 7% growth. But one thing to bear in mind is that spin-off that they did do with Warner Brothers Discovery. So therefore, we will see a slight misalignment in terms of the revenue growth. So it's very, very difficult way to analyze their top line. But for those that do want to see over the last 5 years, it did go from around 171 billion to 121 billion. So what will be interesting to see is when we get their latest annual report for December 2023, which we should expect around January, February next year time, to see how well they have improved on that December 2022 revenue top line figure. In terms of the bottom line, well, how does that compare? Well, we can see if we want to look at more recent data, 2021 around 20 billion on the bottom line. 2022 wasn't the greatest year. We do see that net loss of 8.5 billion. Again, it will be very important to see December 2023 how they do perform. But based on today's quarter and the information released by management, it is looking positive, which is good news for AT&T shareholders. In terms of their balance sheet then, their cash versus their total debt, how does that perform given this is a company with a massive amount of debt? December 2018, 5.2 billion sitting on the balance sheet in cash and short-term investments. Latest quarterly report, 9.6 billion. So nearly double the amount of cash they had from 5 years ago. A nice amount to have, but how does that compare numerically and directionally to the total debt for AT&T? What we can see here, 179 billion, which is a significant amount in December 2018, but it is good to see that total debt has come down to around 169 billion, so around 10 billion paid off, whilst also increasing their cash by around 5 billion. Very positive to see around the net addition onto the balance sheet of 15 billion, so very positive for AT&T shareholders. Now, how does the shares compare to other companies in the integrated telecommunication service industry? So let's take a look at the year-to-date return. As those shareholders know, it has been a terrible time this year for AT&T. The worst performing out of their competitors, down around 18.5%. Again, this does also include those dividends reinvested. Now, in terms of comparing that to the last 5 years, again, I don't believe AT&T will have had a great time, but we can also see over the last 5 years, they have also been down around 19%. Again, a very poor performance, only really second worst to Verizon, negative 27%, with the best performing at SCMWY. One thing I do want to note though is just because of past performance, it's never indicative of future performance, but it is always good to have as an additional layer of review when researching your stocks. In terms of institutions, where they hold around 54% of AT&T shares, what have they been doing over the last 5 years? Well, around 5 billion worth of shares and stocks have been sold, but a larger amount, around 24 billion, have been bought. So the institutions as a whole are buying a significant amount of AT&T shares. And if you want to take a look at the last year, mainly in quarter two, around 15 billion of shares were bought, while 1.4 billion were sold. So it looks like the institutions are really liking AT&T at this price. But one thing to note is we should never base any of our investment decisions on what the institutions are doing and do our own due diligence and analysis. So straight away, dividend safety score of 60, making it borderline safe. Market cap just around 100 billion, making it a mega cap company. For those who believe a recession is coming, well, last recession they in fact increased their dividend. Recession sales relatively flat, which was above the average growth of companies in the S&P 500 during 07-09, as in fact it was negative growth. And it also did beat the S&P 500's negative 55% return, which performed at negative 45. Still very poor, but it did beat the S&P 500. So something to digest for investors that believe a recession is looming. Now, dividend growth, they haven't been paying dividend growth streaks for any years, given the fact they did have that dividend cut as we saw in 2021. And we can see a very, very poor dividend growth performance, negative 11 over the last 5 years, 0% after the last 20 years. But again, previous performance isn't indicative of the future, and moving forwards, do make sure whether it's AT&T or other stocks you have in your portfolio, you are getting at least 4%, whether that's your dividends, salary or other income producing assets, as the US inflation rate over the last 40 years was 4%. Anything less, you are taking a pay cut and losing purchasing power. Now, our first dividend yield theory, it states that a company is undervalued when the current yield sits above the 5-year average, so we have our first sign of undervaluation. Do bear in mind, though, we don't look at any model in isolation and we'll draw our conclusion towards the end of the episode. Likewise, another 5.8 versus 8.6 showing the forward PE ratio. Therefore, when the forward PE is below the 5-year average, we have another sign of undervaluation. Likewise, AT&T below the sector PE at 15.8. Now, I did mention it is towards the 52-week low, but bear in mind, 52-week low does never indicate or signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. As I always say, earnings is susceptible to manipulation by management through accounting, and we have been through many examples in different stock reviews as to why. So we focus on free cash flow payout. Personally, I like around 60% or below. In my opinion, it means management have the ability to offer those double-digit dividends we love to see. What we can see, although it hasn't been below 60% consistently from around 2018 to around the last 5 years, it has been around 60%, which is positive to see in my opinion. And we can see 2023 expected at 49%. Gives me safety so far that dividend is okay. Then moving on from the payout ratios to the earnings per share. Likewise, earnings per share data available for investors that like to see that. Free cash flow is what I like to essentially focus on. 253 in 2013, 173 in 2022. Not the greatest. We can see that decline, but note before that it was on the upward trajectory. So it is one to keep a close eye on. But bear in mind, 2023 it is expected to go up to $2.28. And you need to understand what you're investing in. This is a telecoms industry company. It isn't a company that is fast, free growing like a technological company. Sales growth, again, whilst this is going to be volatile due to the spin-off, prior to that we do see some growth there around 3 to 7% year on year. So it will be important to understand moving forwards what AT&T are expecting and to closely look at their guidance. But we can see here anyway, 129 billion in 2013, 121 billion in 2022. Not really a good comparative again because of the spin-off, but the data is available there for investors to digest. Shares outstanding, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. What we don't like is when they do the opposite, issuing shares, diluting our position as a shareholder, which AT&T have done regularly. So it's not a great sign. 5.39 billion in 2013, 7.17 in 2022. Again, it's always good to understand what exactly you are investing in. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. 10% plus is personally what I like to see. It means management are able to effectively allocate their capital. And what we can see here, for the large part, whilst it hasn't been at 10%, it has been around that with the last few years, 8 to 9%. I can get generally satisfied with that, especially for a telecoms company. If we do see 9 to 10% in 2023, that will make me extremely happy. Operating margin, they have been able to get above that 14% that we like to see as a minimum year on year. So that is positive with the last 2 years in the 20s. Higher the operating margin, the higher that bottom line net income will be, which in turn will mean more dividends and larger increases. Again, free cash flow, very positive to see. Whilst it did have a massive drop in 21-22, it is important to note that we keep an eye on what 23 brings. But so far, so good, given it is above consistently the minimum we look for. Now, probably the most important metric for a company like T, due to the fact it has a large total debt balance, is the net debt to earnings before interest, tax, depreciation, amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. 3.5 being the maximum we look for, and positively enough, it hasn't been over that over the last 10 years. Whilst it has inched close to that in 2022 at 3.47, 2023 is expected to come down to 3.25, again giving me security in that all-important dividend safety and nice dividend we are able to receive on the stock. On the right, purely showing us the percentage of a company's financing from debt as opposed to equity. As always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe button. It really helps the channel grow and it lets me know you enjoy the content. Do hit the bell button as well if you want to be continually notified of these regular videos as they drop. And as always, if you want to grab a copy of the valuation model to get your own companies in your own portfolio, their own acceptable buy price and intrinsic value, do click on the pinned comment below. Now jumping to the first valuation, Graham's valuation formula, the earnings per share at 83 cents. Given the latest earnings per share has been negative in terms of the trailing last 12 months, we have used the average of the last 3 years, so do bear that in mind. Growth rate per analyst estimates at 28, with that current yield on AAA corporate bonds, giving an intrinsic value for T based on Graham's valuation model at $23. Nice upside to the current trading price, which is now around $15 and just slightly higher than the 52-week high, showing some signs of undervaluation in the current market. Bear in mind though, we don't look at any model in isolation and we'll draw our conclusions towards the end of the episode. Now, multiples valuation model, typically we analyze a few companies in a similar sector and size. However, for me, the only real comparison here is Verizon, and as there is only one comparative, I don't believe this is a good model to use. But typically, we'd get the average of the PE multiple and multiply it by the earnings per share. And in this turn, it would give a stock price of $5. Again, it's not one we're using, but you can see how we would use it in the future. The second model we're using, the dividend discount model, we have the yearly dividends. We see that really bad dividend cut that we received as shareholders. Average growth 8% negative, so again, not good. But forward looking, I am estimating a minimum of 2% growth. Whilst this may not exactly be what you would be looking for, I do believe it to be on the more conservative side. As always though, if you do want to run your own percentages through based on your own estimates, you can grab a copy of the model below. So the DDM price coming to $19. Again, nice upside to the current trading price, but slightly lower than that 52-week high, again showing signs of undervaluation in the current market. The discounted cash flow model, we have the free cash flows year on year, average growth rate around 5.4%, with analysts estimating around 3.5%. Using the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide that by the shares outstanding gives a DCF price of $24. Again, slightly higher than the 52-week high. Nice upside to the current trading price, showing again signs of some severe undervaluation. Now, the intrinsic value, as always, is the average of the models we run through. And again, if you do enjoy the content, value is being provided, hit that like button. It really helps the channel grow. And do click the bell if you want to be continually notified of these videos. So the intrinsic value at $22. Now, with the current price at around $15 pre-market, what I would suggest personally is 10% if you believe it is a wide moat, strong financial metrics, good forward-looking data. Now, for those who don't believe that with AT&T, I would agree you need a larger margin of safety, especially with the amount of debt they do take on, but the earnings does give some comfort forward-looking. If you were looking at a 20% margin of safety, your acceptable buy would be around $17.57, and if you're looking at a 30% margin of safety, your buy would be up to $15.38. So what this is insinuating is if you were to essentially believe or go with the estimates and judgments we've run today in today's episode, you would be looking at a margin of safety of 30%. As always though, do let me know your thoughts in the comments below. Are you looking to add T, looking to sell, or just purely on the sidelines speculating? Wall Street do forecast the price to have some nice upside as well, seeing highs of 1922 over the next 12 months. As always, let me know your thoughts in the comments below. Like if you did enjoy the video. Also grab a copy of the model if you want to run your own companies through to get your own acceptable buy price. And if you want to join us in the Discord, do click on the Patreon link below where we're talking about all buyers and sells and anything stock market and finance related. As always, have a great day. Catch you on the next episode and take care.